Economic news took main stage this week as domestic markets remain mostly flat, zigging and zagging a little, but ending pretty close to where they started. When you hear people talk about markets or domestic markets, we're talking about a collection of company stocks called an index. There's three big ones, and they're all a little different. One's all about tech, called the NASDAQ. Another is all big, old-school corporations, called the Dow. And then there's the all-purpose S&P 500, the index most investors use to compare their own performance to. Well, let's get back to economic news and all that jobs data we've been hearing about. There was some mixed data on jobs and unemployment this week. First, the good news. Unemployment is down below 7%. That's great. Now, the bad news. Way less jobs were created in December than we expected, we being all those smarty pants number crunchers in their ivory towers. The devil is always in the details. Unemployment is down, but job growth isn't growing fast enough. And lots of unemployed people have simply given up. Almost 40% of people over 16 aren't working or looking for a job. The requirements for what we call the labor participation rate. That sounds like a big deal, so let's break it down. 63% of us are working right now. The most Americans we've ever had working was about 67% in the late 90s. That's just 4% less than the high, but that 4% is roughly 13 million real people. Chances are you know one of them. Stocks ended the week without doing much, and the S&P 500, the index I use the most, was up just a little, not even 0.5%, while investors try to figure out the impact of the jobs report. Investors are always interested in job growth because it's an important indicator of the economy's health. But right now it's even more important because of the possible effects it could have on the timing and slowdown of quantitative easing, or QE. That's a topic for another time, but keep it in mind as you watch. Bonds are seen as a safe haven. You can keep your money in financial markets, but still buffer it from big losses in stocks. All the money going into bonds pushes yields down, making prices go up. So right now, the yield on the 10-year U.S. Treasury, a benchmark for other bonds and mortgage rates, is under 3%. It's lower than last week, which pushes bond prices up, making it a good week. The force behind all of this right now is quantitative easing and the Federal Reserve. There's lots of changes happening, and a whole series of videos is in the works, so stay tuned.